Okay. So if you were appointed the advisor to the CEO, what would be the one thing that you would advise them to improve the business?
Since from our analysis, we found that their current business in Thai market is already saturated and also facing the intense competition. One of the possible choice may be to expand to other product line. So the company might join with or partner with other low-cost construction material manufacturers to form the low-cost home improvement retailers. And by doing this, the company will be able to catch larger group of the customer as well.
Did you look at historical price to book value of the company relative to peers? And what are your observations?
Currently, the price to book value of the company is 8.5, and for the relative to peers, the peers is only 2.8, so it is much higher than the industry average.
Would you relate that to the confidence of the market given its strong dividend yield, high dividend yield?
For the fact that the company has really high price to book value, it is due to the fact that the company has really high the return on equity as well, and it's why the market has already assigned this high premium to this company. But however, looking forward, in long term, we think that this high return on equity will not be able to sustain due to first, the increasing in the competition from import ties that will finally drive the margin of the company down, and also the expansion plan of those home improvement retailers that target exactly the same customer. This will make the company need to lower the price in order to catch more customers.
And in addition to that, it is true that DCC has been paying quite good dividend yield. However, after we done some research, if you look at the slide, you can see that there are some other stocks that pay a higher dividend yield and also have a lower beta comparing to DCC.
Just in terms of the peer comparisons, you looked at the price to earnings ratio and you said that DCC is in line with the peer average, but looking at that Siam Global House TB seems to be a bit of an outlier. Is it truly comparable? It just seems weird that the numbers are so different.
It is because DCC operating in such a unique business model. They have engaged in both manufacturing and retailing business. So in selecting the peer, we have segmented down into 3 tiers in order to be able to capture all the exposure of DCC business. So to elaborate more on Global House is Thailand's one of the top Thai home improvement retailers. So, and it is the nature of Thai stock market that investor, particularly retail investor, would likely to assign high premium to the retail players in the retail segment. So that's why we did not incorporate the relative valuation into our main valuation.
Can you explain how natural gas is priced in Thailand? Like how quickly the fall in oil prices might translate into lower natural gas prices, and also whether the recent fall in oil prices will lead to a positive earnings shock for the company in 2015?
For the natural gas price, we found that the correlation between the natural gas price and the global oil price is 0.6. So we forecast the gas price based on the forecasted oil price from the IMF, the World Bank, and the economists. And this result in our forecast of gas price, it has been reduced from around 400 baht to 350 baht per million BTU in this year. And this result in the increase in net profit margin from 17% to 19% throughout the forecast period.
DCC has got 195 outlets. Are they owned by the company or they are rented by them?
So since we have limited access to those information, but according to our estimate, we think that around half of total the company actually own around half of total stores.
So did you take into account the replacement cost or the value of these outlets in your valuation?
As I mentioned earlier that we could not obtain that information accurately, and by calculating that, it would bring another aspect of takeover aspect. So for this content, we would want to focus more on the investment aspect, and therefore our target price still indicates that they should sell DCC.
Since the company is so reliant on natural gas prices, do they do anything to hedge potential changes? Is there anything they have done or can do?
They didn't do any hedging on the natural gas price. However, in the past year, they have been trying to reduce the amount of gas used, but still the natural gas cost is still 30% of the production cost.
You mentioned that Upcountry is seeing a bit of a negative, I guess, income shock from the lower agricultural prices. But I would think in the long term, there's still a lot of income growth, for the Upcountry population. It is quite a large part of Thailand. How do you weigh those two in the assumption that the growth is going to be limited for this company?
For the Upcountry growth, based on our research, currently is a downside of the agricultural price, and because 40% of population in Thailand are agricultural, and the main target customers of DCC are low income, and but the agricultural price are not only factors that we concern about the Upcountry demand. The other major factors is the household debt, which is comprised to 84% of GDP, and if we calculate the debt to income of those low income people, it accounts for around 50%. So this would be the limitation of the demand coming from the Upcountry.
Can you tell me what part of your target price of 4.54 comes from the distribution or the outlets, and what part comes from the manufacturing side? Have you done the breakdown?
Company has really unique business model of manufacturing their products and also distribute it through their own store. So we do not separate this business model into two parts. But we rather come up with the end sales growth instead. And from our analysis, the sales growth would be dropped from the 6% in the past to only 2.5% throughout the forecast period.
So one of your major arguments for this, for your recommendation, was around the lack of liquidity or free float. How does this compare to its competitors? Have you analysed that?
So for the free float of this company is around 36%, but if you just compare with the average in the stock exchange of Thailand, it's around 40 to 50%, which is quite higher than this stock. So we think that this would be the limitation for the large institutional investor to invest in this stock. And with the lower free float of this stock, it would result in the low liquidity, as we mentioned earlier in the presentation, which is around, the trading value is around $500,000 per day.
When you speak to management, are they aware of these risks, and have they done anything in terms of their long-term planning to mitigate, like for example, against the entry of Home Pro and others into their space?
And unfortunately, we didn't get a chance to meet the management since they canceled our interview after the submission of the questions, so we cannot have a chance to talk to them.
But according from historical data, as my colleague has mentioned earlier, that it has become a norm for this company that the management would likely to miss the target expansion as well as the target expected the earning growth.
You mentioned the foreign limit of 35%. What is that? And on the main slide, you mentioned a foreign shareholding limit of 35%. Is it what the foreigners own, or is it the limit?
It is the limitation for this company that the foreign investor cannot own this company more than 35%.
Any negative catalysts that could come up to cause the share price to decline in the next 3 to 6 months?
So since currently Thai people has underestimated the threat from the import, so when the announcement of the import value has been out, it is when the share price will start to drop.
Not to mention about the Federal Reserve that can